Good morning, good afternoon, good evening, good night, wherever you're watching us from around the globe, because we're live on the internet where you can watch us real time anywhere. And we do have an audience that spans all over the place. We got a really exciting guest today. We got Tavi Costa joining us, who's probably, if you follow macro inflation, everything that's happening with the Fed, I don't know that there's anybody who's on fire more than Tavi. Really excited to have him come on here and give his thoughts. It's Wednesday, March 24th. If you are watching us on YouTube, please hit that like, subscribe, notification button. Stocks are generally kind of flat this morning. The micro cap and small cap world not doing so hot. Perhaps we'll get into that later on in the show. But let's buckle up and get started because we're going to have a big one today. Tavi, I am thrilled to have you on here. I have been following you on Twitter for a long time. You've got a huge following, but most importantly, you always seem to put together these graphics on your Twitter feed that are so thought-provoking. So thank you for joining us.
Well, thanks for having me, Steve, and thanks for the introduction. I really appreciate that.
Okay, so let's get started here. So the Fed last week they met as per normal. They didn't really say a whole lot. Different spokespeople are plotting the curve with interest rates rising a little bit earlier than others. What's your take on the events that happened last week with the Fed?
I've been trying to step back a little bit, especially given the moves in the markets that I think are not reflective a lot of times of what is really going on. The Fed's policy tools were essentially designed initially and originally to control, especially money supply, depending on what the economy is doing, if it's heating up or if it's just tightening. And with that in mind, I think it's absolutely critical for us to step back here and consider where we are today. When you look at 5-year inflation expectation, it's at a 13-year high. And so effectively, almost every monetary and fiscal policy today is pedal to the metal. And so M2 money supply, for instance, I was just looking at the expansion that we had in the last 8 weeks or last 2 months, which was about half a trillion increase. It is the largest 2-month increase since June of 2020, which we saw a massive jump back then. So it's reaccelerating the money supply growth. Now we have the QE pace also picking up significantly. It's close to $300 billion worth of treasury and mortgage-backed security purchases for the last 2 months as well. And if you look at a chart on a 2-month basis aggregate, you can see that it's also picking up significantly. The Fed funds rate is the same. I mean, we all know that the Federal Reserve is not even thinking to raise rates. And finally, when you look at the fiscal stimulus or fiscal spending, it's even more radical. We're seeing basically government deficits reaching again its worst levels in 70 years. So meanwhile, what we have, especially according to last week's speech and statements in general, is that the overarching message, as policymakers like to say, is that inflationary forces are transitory. And yes, central banks got away from all those policies along with the government policies back in 2008, but the social and economic impact of most of those policies that we're seeing today are complete opposite than what we saw back then. The helicopter money policies from the government marry along with this extreme monetary policy that we're seeing certainly will, in my view, create inflation. So it's astonishing to see, again, inflation expectation at a 13-year high, 13-year high for 5-year inflation expectation. And so when no one is really worrying about this and thinking this is just transitory, it does not look transitory to me at all. Sure, we've had a big run up in commodities. They need some breathing, and that's what we had in the last week or so with oil prices declining. Even 10-year yields needed a break from that move that we saw with yields moving up almost 50 bips in the course of a few months. And so those are big moves. And I think we're just seeing a pause from what is supposed to be a much larger move. Yes, 10-year yields are probably going to take a larger pause. We didn't see the initial movement was that precious metals were the ones really moving along in the first part of this inflationary sort of movement. And then now we're seeing cyclical commodities moving, really accelerating to the upside, where precious metals have gone basically sideways and down, depending on what you look at. For miners, they haven't really done much. Besides all this pessimism that we see in the industry on a quarterly chart, they have barely moved. So, it's astonishing to me, the sentiment right now, when we have all the stars aligned for gold, silver to perform really well, along with other monetary assets, which, you could say that Bitcoin is part of that category as well. Copper used to be in the past in some areas, part of the monetary system too, even though it's much more of a cyclical and industrial commodity today. But lots of opportunities out there to take advantage of this real disorder that we're seeing from the Federal Reserve and the government side of things.
Okay, so lots to unpack there. Let's start with that inflation talk, that it's transitory. What do you think? Do you think that we're just going to see like a really tough year of inflation, and then it's going to come back down to normal levels, or do you think we're going to see something that's more sustained?
Well, what I think it's there are parts of what happened back in March of 2020, or even a little later in April, for instance, with oil prices going negative. Those are obviously transitory forces on a year-over-year basis of calculations that we see in a lot of the CPI calculations, even though it completely understates what really is going on. It's important to look at those, especially inventory disruptions that we're seeing, along with the capacity, in this industrial capacity being still really low relative to historical averages. And so I think that there is a degree of transitory forces, but we're seeing a very different move than what we saw on what used to be sort of transitory and reflationary, first of all, when we saw this come back from 2009 all the way to 2011, and that we saw the whole pause of gold entering a bear market after that. And I think a lot of people are looking at those moves in 2010, 2011 and comparing that with today. And I think it's completely opposite. I think the inflationary forces are real. Back then, we're actually exiting a lot of those policies. Again, we are at the most extreme amounts of monetary and fiscal policy that we've seen in a real long time. And some of those parts of the policies are the most extreme ever. And so, calling it transitory, but not acting accordingly, instead, continuing to have those policies at an extreme level, I think we may see the cost of it this time around. I don't think central banks were going to get away with what they got away back in 2010, 2011, where the real inflation was just in asset prices. I think this time around, we're going to see, a lot of other prices moving significantly higher. I mean, you tell me what price has not gone, 10, 20% higher in the last year. I mean, I go to
that point now.
Yeah. I mean, I go to the grocery stores, I buy things. I rent places to go for vacation time. I do all stuff that normal people do as well. And I'm observing that prices have moved significantly. And, part of it is people are trying to stay in business. Part of it is just people taking advantage of stimulus checks ahead of that. We're seeing a lot of vacation homes and all those rentals increasing significantly recently. We've got one of our analysts really following that. It's pretty interesting how there is a real pattern of prices moving higher, not lower. And instead, still those deflationary forces, talks is still really pronounced still.
Sorry, you've seen short-term rentals that despite the pandemic and the lockdowns and everything else, prices are actually going higher rather than lower?
And I'm talking about, obviously, in some areas of it's all regional. In
Yeah,
Denver,
absolutely.
and in Colorado, I can assure you that it's not going lower. It's going higher. In fact, we're looking for office space. Our lease was up a few. Right in the end of the, I guess, in the end of the year 2020, and we're now looking for another space. And there are no spaces to release right now at a good rate as we used to see before. And so, I can speak for a personal experience here at Costa Capital that we are going through, and we're going to have to pay for it. And so, if this is the case across the board, I have friends that are in still in situations where they're suffering from prices moving significantly higher. I mean, just go to the grocery store. I just pay. Yeah, I I drink organic milk. I have no problems buying organic milk, but it's $8. The gallons are $8 right now in the place where I shop. So $8, where it used to be, if I remember correctly, probably between $4 to $5. So
see, I know that you both will probably disagree with me here, but I think that the grocery store isn't necessarily a good measure. And the reason I say that is because I'm less likely to notice a gallon of milk going up 3 cents every other week because I'm paying the bill. I'm not paying that close attention to it, right? It just kind of slowly grows. To me, where people seem to be noticing it a lot more is stuff like lumber. Now, lumber, as we all know, it's gone insane, but you only buy it maybe once, twice, 3 times a year. So when you remember that $4 to $8 to $12 for a 2x4 or whatever, right? So to me, the grocery store doesn't work as the best analogy just because it's so gradual and you're buying so frequent that you don't remember over the long run.
Sure. But that's not reflected on CPI either, is it?
Oh, absolutely.
I'd add in, I went to the store the other day to buy some soda, and that's what you guys in the States call it, soda. You are in the States, right?
Yes, I am in Denver.
That's what I thought. Yeah, that's what I thought. A 2-liter bottle of Diet Coke at this Rexall, which is a pharmacy chain around the corner from me, $4 for a 2-liter bottle. $4. And I don't know, like, is that just a pharmacy but they sell a lot of grocery type products. I thought that was really interesting. And I'm seeing the prices of everything around us. Something I worry about though, is I got a lot of friends, they've gone to school, they've worked really hard to try to get ahead. And then they're now in these jobs where they're not getting any inflation pass through. And they're looking to buy their first home for their family. And I got friends that are like, I'm having one kid and I'm stopping there because I can't afford anymore. And it feels like nobody really understands all the problems central banks are creating with this policy.
Yeah, and then you start to observe as well this hoarding situation of hard assets. Some people buying Bitcoin. Nobody's buying Bitcoin because they're going to use Bitcoin to buy coffee in the next coffee shop here. That's not the case. And they're buying Bitcoin the funny thing about things like Bitcoin is that as it goes up and as it works, it almost feeds this anger for the monetary disorder and fiscal disorder. It really does. People were like, yeah, this is crap. And so, I'm making money out of this whole situation. And so, I think that's one of the strongest messages out there is the fact that there's people already profiting from this situation today. And so, it will probably continue. I think that we saw similar situations in Brazil and I'm from Brazil, and I remember my dad in the 90s had to buy a motorcycle because there was hyperinflation going on. Now, I think that there's all this talks about hyperinflation in the U.S. is a bit extreme. Usually hyperinflation, it really feeds on its own when you have an extremely corrupt government. And I'm not here to say that the government here in the U.S. is not corrupt, but there's no comparison to a place like Brazil, Venezuela, China, Turkey. It is another level of problems. So I think we'll take a time to really develop those things. I mean, in the last century, what we saw was that the decade average CPI year-over-year change was somewhere close to 6% in 2 decades, in the 70s and the 1910s. And, again, do the math and you see that it's about 50 to 60 years, depending on how you calculate this difference. And so, it takes long for inflationary forces and cycles to really build up. And I think we're at the beginning of one. And I think there's a lot of investors using their investment approach of this inflationary forces happening. In other words, inflation actually falling, not increasing over time. And so things are about to change. This rotation from growth to value is real. You look at the year-over-year change of that ratio of the Russell Growth 1000 versus the Russell Value 1000. It's real. It's happening. And so it seems a lot like the 2000s and when the peak of the tech bubble, where profitability begins to matter all of a sudden. Why? Because cost of capital begins to rise too. And so, whoever is providing that liquidity to companies that don't make any money will begin to really ask or require, when are you going to start making money? And so I think this is, and again, it feeds in inflationary forces too, right? Because companies begin to, the first step is, well, we got to raise my prices. I can't really do anything about this. So it's, you start really thinking about the feedback loop of those forces. It certainly creates inflation. And I'm not calling for hyperinflation, but I think it will be kind of like the 70s and the 1910s. And, risky assets in this environment do not do great, very well. They actually, when you look at the average annualized return of equity markets during those periods of the 1910s and 1920s, it wasn't great at all. In fact, we saw sort of a market that went sideways during that time and very volatile at some points. And so, anyways, I think that a lot of people are not positioned accordingly.
Yeah. So here's a chart of yours that I love. I found that this one here was super thought provoking. Let me pull this up. We have commodities to equities ratio, and it seems like every time we have some sort of a stock bubble, it's followed by some sort of a commodity super cycle. That's kind of what you're getting at here, right?
Yeah, and I love this chart because I think it fits. There's two very prevalent narratives in the markets today. One is the Roaring Twenties, and I'm sure you guys heard of it. It is pent-up demand where personal income is growing to a pace we've never seen before. We have savings at record levels, which is seen as deflationary. But when you think about the delta, the year-over-year change, possible change of that in the future, is that they're going to drain those savings and probably boost consumption. You have the net worth of individuals improving, so all that sort of feeds this idea that we're going to see the Roaring Twenties. But the Roaring Twenties happened because we had a financial reset in the 20s first, in 1919 and 1920, post the pandemic problems. We saw an inflationary bust that occurred, and actually equity markets fell apart. I think it was over 40% of a decline. So the financial reset really allowed us to see the Roaring Twenties. Actually, tax rates were falling at the time. Now, right now, we're talking about quite the opposite. Now we're seeing that the Federal Reserve cannot take all the blame here, I shouldn't say the blame, but cannot take all the purchases of treasuries. And what we may see is that revenues need to go up, revenues from the government side. So taxes have to rise. So what is the second narrative? The first narrative is Roaring Twenties. The second narrative is we're on the verge of a liquidity crisis. Well, it's partially right. I mean, we do have, asset bubbles everywhere aside from commodities market. And so the speculative environment certainly creates this idea that we may see a reckoning moment that will in fact be deflationary. So where are we and what fits right in between those two very extreme possible setups for the following years? Well, it's commodities to equity ratio. We may see inflationary forces where, investors and the population, households will be looking for hard assets to protect against that, where, Ray Dalio is right. Cash is trash, probably trash for longer than the following year or so. And so we may see this hoarding, again, scenario of hard assets where it creates commodity prices to go up, where there's an environment where there are no alternatives of investments that yield more than inflation expectation. So you start looking for anything that will appreciate in price. And what is cheap in price today? Well, commodities are cheap. And so a lot of large capital allocators may start flowing towards those asset classes. At the same time, they may get out of equities and corporate bonds that are at record valuation for the first time in history together. Not even in the tech bubble we saw that. So that flow change, from record overvalue assets to record undervalue assets, which is precisely the commodities to equity ratio, is where I think every investor should be looking at as a way of being positioned for the next 5 to 10. Look at this chart. The trends are long. There are 5 to 10 year trends, and so I think we have a lot ahead here to unpack.
Okay, so you grew up in Brazil, and then you come to the U.S. Now I don't know a lot about Brazil's economy, but what did you like? Speaking of myself, I'm 37 years old. I've never really seen a bad economic time during my lifetime. This is probably the closest thing, and quite frankly, for those of us who work in capital markets, it's been a great year. So, what experiences did you have in Brazil that made you? Because it seems like you're obsessed with inflation. You're obsessed with how central banking works and just economics in general. What was the experience like in Brazil that brought you to the U.S. and sort of made you so focused on all this macro stuff?
Well, look, I think there's a lot of takeaways. Well, I grew up in an emerging rich family, I would say, a family that was doing very well in the 90s, that was doing very well in the early 2000s. And then what happened was after that was that my family business basically went broke. And I was probably 13, 14 years old when I saw all that happening. What a moment, because I was, starting to be older, and that was a period when we went from driving the nicest cars to, and I'm talking about more of the standard nice car in Brazil, to driving one of the worst cars in Brazil, and moving to a very small apartment and things like that. So I saw, this real economic decline in my own house. And so with the risk of this inflationary forces, especially driven by a highly corrupt government, where everyone loves to say how Brazil is an emerging market, but it's been an emerging market forever, has never emerged to something. And so, and for me, I find it very interesting when I see a lot of analysts and especially portfolio managers discussing about Brazil with so much certainty that it's the next economy to do very well, when they have no idea about the political environment and the real risk of state-owned companies in places like that. And so that really started for me in terms of looking at especially this monetary disorder. So in the 90s, what we saw in the early 90s of Brazil was a lot of money printing that led to hyperinflation. Again, different scenario than the US, given the political environment it's a bit different. It's a developed economy versus an economy that's not developed at all. And so, and even worse in places like Argentina, Venezuela, I would argue. And so in the 90s, we saw money printing as a big part. And then now what we're seeing is that they shifted away from money printing to now work on fiscal stimulus. Why? Because they think that, well, if we print money, we devalue our currency. So what we might do now is just increase government spending instead, and maybe borrow from the future. And so it's happening in a huge way. So government deficit and government debt in places like Brazil and other emerging markets have shot up significantly, while they have not been to the same degree that we saw in the 90s to get out of the economic decline. We didn't see the same level of monetary stimulus. And so the monetary stimulus that we're seeing in places like Brazil which was the first place now to really change their policy, where they went from, basically one of the lowest real rates in the world. Think about this. I mean, it's lower than places like Switzerland, the US. This is real extreme rate policy, to now having to raise interest rates because inflationary forces are getting out of control. And my final thought on this is this wrong thought about the wrong idea that especially Brazil, when you have a depreciation of the currency, it actually boosts exports and helps the economy. For me, that's all wrong. I think there's that's one initial factor that helps the economy, but there's the other side of the coin, which is if you're exporting primary materials, especially, and you're really actually importing a lot of final products, and your economy is actually having a dysfunctional problem with the monetary system. In this case, a depreciation of the real versus the dollar. Well, your final products are getting significantly more expensive. That's exactly why we see inflation rising, and then the central bank has to act, and immediately we see a painful period of the economy in places like Brazil. So, it's I think a lot of people end up seeing and making up analysis on places like emerging markets in a very wrong way. And so, the last 10 years, 8 years, the Brazilian real basically depreciated versus the dollar. Do you really want to bet the Brazilian real is going to appreciate versus the dollar here in the following 10 years? I think that the history is against you. So I love when we have a full year of appreciation on the Brazilian real, because it's almost certain that we're going to see a reversal right back to a declining trend in the following year. So it's anyways, that would be my takeaway from Brazil.
Okay, so that's kind of an interesting point. It sounds like, if I'm understanding you correctly, that the Brazilian real's done well. It's appreciated for the last year, so it's almost a certainty that they're going to find a way to devalue their currency. Which brings me to my next sort of question for you, which is, we keep seeing everybody say, okay, the U.S., they're printing way too much money. We've expanded U.S. M2 over 25% in 1 year. Now we look at other currencies around the world; they all kind of seemingly are printing the same, right? Like why is it that we think that the U.S. is going to collapse when the rest of the world is going to do this?
So that's a good question. I think it's tricky because there's money printing perhaps is not happening to the same degree yet in some places. In some others, it is. In some other developed economies, we're seeing that. In emerging markets, like I said, I think it's happening more on the fiscal side. Is even worse than the monetary side of things. But no, China is a great example. China's M2 is now 80% higher than the US M2. And it's been growing in a faster pace than the US recently as well, which no one likes to say that. And why? Because they tend to look at the PBOC's balance sheet rather than looking at the overall picture of the money supply, which has been increasing significantly. And so I think what you're referring to is, again, it goes back to those two narratives, the Roaring Twenties and the liquidity crisis. The liquidity crisis believes that the dollar is still fundamentally stronger than any other currency in the world today. And I'm in full agreement with that. Living in Brazil, I know that the first thing that people hoard is dollars, and a lot of times are not really Bitcoin or gold or silver. They hoard the dollar first of all, and so I think there's still a case for the dollar to be stronger than any other currency out there, even though we're in the race to the bottom for fiat currencies. And so I think it's interesting for you to look for hard assets relative to those most overvalued currencies. And one way to do that is to buy miners in other places that have those issues, and they have their costs linked to the local currency of that place. And so I find that as one of the most effective ways of being positioned today. Buying a miner in Brazil, buying a miner in places like Bolivia, buying a miner in Mexico. Obviously, you want to make sure that the jurisdiction risk is priced up properly with the level of quality of that project. But I think there's a lot of opportunities in those places. So yes, it is happening elsewhere, and that's where those valid points coming from the liquidity crisis narrative are actually, in my view, correct. And so it's almost like three trades, right? So you have the long commodities, the short equities, but at the same time, you have some long dollar positions to then offset that with the long gold. And so you basically long gold, long silver, long hard assets relative to the most overvalued currencies in the world, mathematically speaking.
Okay, so it sounds like you guys invest in miners. So we got to ask you, we're bottom up, small cap, micro cap stock picker types. I can tell you a little anecdote here that Jay and we invested in this company in the Philippines that was supposed to. They put out this investor deck and they talked about swarming veins and these grab samples. They were massive. Like I think that they had like thousands of grams per ton in these samples, and it was just like, okay, they've got to drill something like reasonable here. It's just a question of how much the market likes the political risk. So we're in the first tranche of a private placement. We wait about 6 months, still no drill results. Another 3 months, no drill results. Finally, they come out, and it's almost pure dusters. Like they maybe had like a few grams per ton in one of the holes. And
I don't even think it was that good. I'm pretty sure I could go in my backyard and find probably just as much. I believe Steve's direct comment to the CEO was, well, at least he didn't hit a water main. Like they were that bad.
So how do you, what do you recommend we do or we think about moving forward? Because we do like risk. We're okay with investing in things that don't work out, but we kind of feel like we got played a little bit on this one. What's your playbook? How do you find the best risk reward profile or opportunities for your fund?
Well, I think there's two types. There's the more historical geological opportunities in different areas of the world. The Golden Triangle being a proven area of other mines that have succeeded in the past, such as the Askey Creek mine, and buying the analog of that mine, which is the Askey mining today, with over 500 square kilometer in that whole region. And so what we like to do is really buy districts. In other words, buy significant exposure to a region that we think looks interesting. And then there are more newer stories per se in areas that have perhaps not developed the same history in some regions, such as Newfoundland, in some areas of Brazil, and so we enjoy having those as well. We have not have issues yet with what you're referring to, but I think that's what it's so important to have a diversified number of companies. We've had companies that we thought that they would be doing really well, and unfortunately they didn't. Similarly to your story, drill results did not reflect what we thought it would reflect in those as the opportunity was proposed initially. And so I think that's really the idea. I mean, we've had most of our plays are in historical regions of where we had significant success, or there's really haven't been as explored, or perhaps have been explored the wrong way, such as the Askey mining is a great example of that, right? I mean, it's been explored many times. It's been over, I think it was over 50 or plus $1 million already in some areas of that property. And so nobody found anything. And so I think that the issue was the way it was explored at the time, and the lack of knowledge of being a VMS deposit that requires a different set of knowledge to really navigate that. And I think that's I think what we bring to the table is different types of network in terms of how to approach those stories in different ways. We have what I believe to be probably the best geologist or exploration geologist in the world today, Quentin Henney. And so we're lucky to have a person like him to really help us to navigate the space in general. But we like to have district plays. And so, we go big in regions as they start to play out. So if you have a successful story, we obviously try to expand our exposure in those regions. And we've been doing that for a while now. And I think it's I think it's a great strategy. So that would be my approach. And there are areas of the world that we try to avoid it completely. Some areas that may have some very successful mines even in the past, but unfortunately it's either not economically or politically viable to function in those places.
Have you guys had moments where, like, I'm assuming that if I sat you down February 2020 and I said, Tavi, I'm here from the future. I'm Marty McFly. Show up on my DeLorean, and I say, Tavi, we're gonna print 25% of the money supply. We're gonna expand it as a result of the economy coming to a screeching halt for half a year. And then I leave. Okay, then I get back in my DeLorean. I go off. Where do you think gold goes? Like, do you think that we're sitting in the low 1700s today?
No, I would have thought that would be significantly higher, and especially, when you really built the whole thesis, that, like, adding to your point, to the fact that the Federal Reserve is now forced to suppress interest rates through the expansion of monetary policies, or expansion of the monetary base, I should say. I would think that some commodities and currencies, if you want to call gold a currency, would be significantly higher. Part of it certainly is, which I didn't believe initially, but the Bitcoin kind of stole the show initially, and it still kind of is. But I still think that's really not something that will take away this opportunity in the gold market. I mean, it's a real opportunity. Is the history of owning gold to protect yourself against monetary dilution has always worked throughout history, and so it's I think it's a lot of people are ignoring that as an important factor. And I believe strongly that pullbacks are where you want to be invested. And it's tough because the sentiment is just so negative right now in the mining space. I've never seen anything like it. Again, take any, whatever it is. I like to use the Philadelphia exchange as a gold and silver exchange or index to really look at that throughout history. And if you take that on a quarterly basis, it has barely moved. And everyone is just so negative about this. It's okay to take a break. It's actually great. I mean, it's allowing at least us, building a business behind this, to raise money before the move. And so I'm a big believer that it's time to be positioned. It's time to continue to raise money and put to work at cheaper valuations. This market hasn't really changed. I mean, gold and silver. I mean, silver was up 50% in 2020, regardless of that sell-off that we saw from August all the way to the end of the year. 50% increase in price. So now you compare that with where a miner could be benefiting from that in that space in terms of their margins, free cash flow, and so forth, and that production of really improving their fundamentals is really astonishing. And again, miners are actually not being capital destroyers as they used to be in the last 25 years. And I think not a lot of investors are really catching that turn. And so, again, it's time to be positioned. It's time to take advantage of a pullback where I think we are in a secular bull market for gold, silver, and the miners.
Okay. Well, Tavi, one last question, and then we'll wrap it up. The yield curve starts to steepen at some point. It looks like it's coming down a little bit over the last few days. You think that we're going to see some form of yield curve control?
I think it's inevitable. The timing is tough to say, but it's inevitable. And especially, well, we're seeing now the most of the purchases already kind of started, but in the 5-year range, 5 to 7 range. And so can they increase even further? Sure. And the reason for increasing is not for funding the government. I mean, they can fund themselves just issuing treasuries in the 5 and 10 year side of things. What I think it's going to be the trigger is it has to be the equity market. And the equity market does not look attractive with 10-year yields at 3%, for instance, or any. We've seen all those issues in the equity markets recently with 10-year yields going up to 1.5%. What a joke! And now a little more than that, and getting closer to even 2%. I think we were due for a pullback in those yields and all that, but it's I think that the general trend is probably higher until we see some painful moments in equity markets. And I mean 15-20% declines that will actually slow down the economy again and force the Federal Reserve to do even more, and even the on the fiscal side. So it's tough because, like you said, we haven't seen an economic downturn, or you're saying we saw an economic downturn. It's the first time you're really going through something like this. But, have we really? Equity markets are at record levels. It's crazy to think that we would be where we are today, and caught me by surprise as well. I'm not here to say that I thought that we would be where we are. I am surprised, and I think it's an opportunity, for all of us. And that could be the trigger for gold and silver to resume this real bull market in the medium to long term here.
Well, I agree, and I think it's going to happen. And what I always say to some of my friends that are very long gold, or some of the junior mining CEOs I talk to, is it's always the darkest before the dawn, and it's feeling pretty dark right now. So I'm here's hoping that we're at the beginning of a super cycle for gold. Thanks so much for joining us, Tavi.
Well, thanks for having me again.
And I hope you'll come back on in the future. It's always great to hear your thoughts, and keep up all the great work on Twitter. I absolutely love your Twitter feed.
Will do. Thank you very much for following.
and if you're just sort of watch us on YouTube or Twitter or Twitch, the Twitter feed is at Tavi Costa. Lots of really thought-provoking graphs. Thanks so much, Tavi. Thank
you very much.
Okay, so Jay, Yellen's apparently back on CNBC. Should we pull that up, or how's about you start off? Talk about some of the news today. What headlines is Jay into right now?
What headlines? I'll be honest. I put out news every morning, but it doesn't mean I'm the most enthused by it. There's not a lot catching my eye right now. Willow last night, I have yet to cover it. Willow last night put out their financials. More so, I was interested in their operational update because they're still pre-revenue. So basically, I'd be reporting on cash, which is why things aren't out yet. They're still saying that the first quarter of 2021 that they will be commercializing their CBG, or their synthetic CBG production. And it's the 24th of March. So I'm starting to think that they may be producing it already. And we're just waiting on some news, but
look at this. I have not seen this video yet, so I haven't even had a chance to vet it. We just posted our DigitalOcean IPO video. Why don't we watch this live on the air while I get to critique?
Sure. Well, so to be clear, I didn't vet it either. I've got full faith in the production team on this one because it was ready right before we went live. So
I'm
3 minutes long.
excited.
Let's go for it.
This is something we normally don't do, so I'm actually pretty excited to check this out here. Let's here we go. Let's see the world premiere right now.
So while Steve pulls that up, as a reminder, DigitalOcean had its IPO as of this morning. They're trading on the New York Stock Exchange under ticker symbol DOCN, and we put a little something together for it.
Okay, so let's. This is the little thing we put together. Let's check it out.
DigitalOcean is a recently listed public company that has roots dating back to 2011. The company completed their Series A equity financing 3 years later, raising over $37 million at a valuation over $82 million. 7 years later, the company plans to IPO at nearly 12 times that valuation, hoping to raise $775 million at just under $5 billion. So what is DigitalOcean? Well, DigitalOcean has created a simple, user-friendly cloud hosting and server-related services platform. What makes DigitalOcean interesting for system administrators is the simplicity their platform offers, with pricing closer to Amazon and Google, while allowing basic system administrators access to a user-friendly backend. Their services are priced on a consumption basis and billed in monthly arrears. For example, at the end of each calendar month, they calculate the cost of the customer's server based on the size of their droplet. On the financial side of the business, the company has demonstrated 25% annual top-line growth with 53% gross margins and demonstrated positive adjusted EBITDA and operating cash flow. There is just one problem. They don't actually make money. The company sees negative net income figures annually and a growing cash burn, as the capital expenditure side of the business is pretty costly, leaving potential investors on the fundamental side to question if operating leverage will ever go up. To that point, the company has seen an average revenue per user grow from $35.97 to $47.78, while having cash flow from investing continue to expand. The big question as DigitalOcean begins trading is how investors will view the overall market opportunity. DigitalOcean is competing against players with central bank-like balance sheets in Amazon and Google. From our view, the business is largely infrastructure-based with little moat and constant capital expenditure requirements. Meanwhile, the IPO is being priced at multiples much higher than that of the GoDaddies of the world. And if you believe the company has an upside, you're likely betting on the market viewing the equity similar to the Zooms, Shopifys, and Cloudflares of the world. That being said, it's 2021, and we wouldn't be surprised to see the market love the story. In a fast money world where companies are valued on metrics like price to sales ratios, overall revenue growth, and the ability to yell, "Hey, we're disruptive tech!" DigitalOcean appears to have it all. Just don't get left holding the bag if there's ever a return to common sense investing. Thanks for watching our deep dive video report. We'll see you next time, and in the meantime, don't forget to like, subscribe, and share.
Okay, so I can already see a few issues that I have with that.
Yeah, you nitpick. I think it was great overall.
Yeah, it was solid. But really, what I wanted to actually talk about was the DigitalOcean IPO. I mean, we've had an experience with DigitalOcean. A few
I mean, I'm not looking to bring on a lawsuit by any means, but when we use DigitalOcean, it's pure garbage.
Well, I mean, the problem was we were working with a system administrator. So DigitalOcean is effectively what they're trying to do is they're trying to take what Amazon Web Services does or Google Cloud, and they're trying to make it a little bit more simple for, people who want to do their basic system administration, which is the kind of thing for people who don't do this full time. Is it's kind of a lofty goal. The pricing's very, variable would be the best way to put it. But my issue with it is that this is an infrastructure play. So when I pull up the DigitalOcean S1 and I sort of look at it, it's like, okay, they're generating tremendous operating cash flow, but my goodness, is this a capital intensive business? Because you're providing infrastructure. So the question becomes, like what's the value prop here for why I want to invest in this thing and watch it burn cash as they go and they try to take on two behemoths in Google and Amazon and some of the other companies out there. I just don't see it. I think that the hat tip to the bankers and VCs behind DigitalOcean. You took your company public at the right time, but anybody who's serious about investing, I might be missing something. I'd love to have somebody from DigitalOcean come on the show and explain it to us, but I don't get it. I don't get why anybody wants to pay $5 billion for this company.
Yeah, I mean, we had a very poor experience. Probably the best example is they list one of their competitive advantages as being customer support. We were having some issues. It literally took them 2 months to respond to us, at which point I would have had some select words had come to me rather than to Steve. To me, I find it hard to see much of an advantage in a space where you're just providing infrastructure, right? Like, there's a lot of industries, not just this, but where you're providing infrastructure, it's really hard to differentiate yourselves from the guy next door. And I mean,
especially like you're competing against companies here that are gigantic. DigitalOcean is $47 per share. NYSE.in. So I had to read that out loud to make sure there was no typos. But I mean, they're not. They're kind of in this sort of weird niche-y thing where they're not quite. They're not GoDaddy, right? And we really want to compare them to GoDaddy or Wix. Wix, by the way, trades at 16 times sales. GoDaddy at like 4. GoDaddy offers a lot more customer service. DigitalOcean is supposed to be, you already know your stuff.
No, I will say there are some differences there. GoDaddy does domain hosting and everything else. That's not DigitalOcean's business. DigitalOcean is more so focused on the server and everything behind that. So there are some differences which make it a hard direct comparison to some names like GoDaddy. Wix themselves, they provide effectively a WordPress. It's not WordPress, but it's a content management system for people that aren't capable of designing their own themes through coding and everything else. So that's more a service to me rather than infrastructure. I guess you could classify it as online infrastructure, but to me, they aren't going to have the same hard cost as someone like DigitalOcean would. Because remember, if I'm using a server from DigitalOcean, they need to have that physical server in place and ready for use. So that means they need additional capacity beyond what they're currently selling because you need that space for growth, right? So I just have such a bad experience with DigitalOcean that, truth be told, I don't have unbiased.
So I think that it's you were when you signed up for DigitalOcean, you were expecting a bit more of a customer service and GoDaddy type experience.
Absolutely.
And what you were left with was somebody who provided you with infrastructure and literally no support, which is strange because they talk about how great their customer service is in their S1.
And that's not what we experienced in the slightest.
And that's fine. Like, it's fine to be the lowest priced player in a market and not offer great customer service. I think that there's a legitimate use case and business case.
Oh, absolutely.
A real value prop. But when you're coming at us with we're the one of the top groups at customer service, and the story you're really getting at was we had a website that was hosted. It was actually the deep dive was actually hosted on DigitalOcean for a while, and my credit card ran out, and I forgot what email address I used to set up the deep dive, and I had to spend a whole morning trying different email addresses, and the whole reason that I did it was because you get afraid of like hacking and you take these extra security measures, and then you end up like losing a username and password, which is what happened.
So for those of you that experienced downtime one Sunday last July, that's exactly what happened. It was all because of a credit card. But here was the interesting thing, was that I reached out to them in every way I possibly could to their customer service. You know how long it took for them to respond to me? 2 months. It was 2 months later that I got a response from them over, oh yeah, this is your username. Like, well, geez, guys, thankfully I figured it out. I woke up hungover on a Sunday morning and I just kept trying different email. I tried it for literally 2 hours. Couldn't even remember that I made it. Thank God Gmail kept that email running because I needed it for the verification, or else I would have been able to enter. So I do think that there's problems with the model, and I think that like it's a little bit too nichey. Like it's user friendly for the sysadmin. Look, if you're a sysadmin, you should be comfortable on Google Cloud and Amazon Web Services. This should be part of your role as a sysadmin. So like I don't really exactly get DigitalOcean. Now, maybe I'm being foolish, right? Like maybe graphic designers would prefer something simpler to use than Adobe Photoshop. But they all use Adobe Photoshop. And those of us who don't know how to use Adobe Photoshop, we go on it, we scratch our head, we throw our mouse, throw a temper tantrum, and then give up and then go over to Microsoft Paint. But people who do this professionally, that know how to use graphic design, they use Adobe Photoshop and they're totally fine with it. So I think that this is a little bit high. What's the price to sales that they valued it at? Wasn't it 13.9, I believe.
13.9. I think that's high, and I think that this is an IPO that's the.
Actually, if you want to compare it directly on a price to sales basis, just go to the bottom of the article.
Yeah, and that's one of my issues with this article here is that we didn't label the y-axis, which is driving me mental. As a former math teacher, it's but yeah, so these are supposed to say price to sales ratios here. And you can kind of see DigitalOcean is being priced similar to like the Salesforces and Squares, PayPal's, Zoom. So there's some upside, but you've got to really feel comfortable that they're going to be able to raise the capital to take a real run at Google and Amazon, in which case it's a race to the bottom. So I don't know. I don't like this one. I want to cover more of these as we move forward, because I think that this whole cloud computing space is just so dang fascinating.
Do you want to reveal what you're working on right now? Or?
Well, tomorrow we're doing SEMrush, which to me is much more interesting.
SEMrush or SEMrush?
The people I know who have used it historically, like we got people on our team that have used it, they call it SEMrush. And okay. I think one of them actually knows the founder, which is crazy. And to me, that's a real cloud computing company. I don't view DigitalOcean as a cloud like there's a bit of a cloud computing component there, but I honestly view it more as cloud infrastructure. And I don't know how you price that, but I think pricing it at like a multiple north of 10 per sales is just too expensive and too rich for my blood. But again, I haven't sat down with the company. I haven't like really looked under the hood of what the business model is and what the long-term strategy is. I just don't get it. It seems like it's just too competitive. Your competitors are too large, and there's not going to be a ton of margin. I just don't see how this ends well. That's my take on it. I'm the first one to admit when I'm wrong. But if I were to go bull or bear on an IPO day, I'm going bear on DigitalOcean.
Sorry, what's it trading at right now?
I don't know. Has it started trading yet?
I thought it was this morning. Sorry,
yep, it's down 6.5%. Look at that. Boom. It's already down. It's already. I didn't even know it started trading yet.
Actually, it's hit a low of 39.
Look at that. Look at that. Small cap calls it. It's small cap calls.
That's interesting. You're showing a bit different data than TradingView.
Well, I mean, that's just a Google search. I mean,
yeah. So right on the open, it had a high of 43.57 and a low of 39.07. So, truth be told, I think the market is kind of getting saturated with stories of this nature, and I'm surprised it's priced at the high end of their target. I believe the target was between $44 and $47 a share. And it went right at 47, and it's not even at the low end of the target right now. Yeah. So what does that tell you?
It tells me everything I need to know. I'll tell you that much.
Exactly.
Okay, so let's wrap it up here, because I'm supposed to be on a call at 1:00 for some conference call. Anything else interesting coming out at the dive today, or just push that DigitalOcean piece?
DigitalOcean got pushed. Shortly here, we have Todd Harrison on the daily dive. After that, we've got some analysis on energy fuels by Jim McFadden. And I can't tell you off the top of my head what comes out at the close. So lots to go. It's been a busy day on the dive today. So.
Okay, perfect. And quick little disclaimer here. Nothing we say is intended to be financial advice. If you're looking for that sort of thing, please go find somebody who's licensed, not somebody like myself or Jay. So this is for informational and entertainment purposes only. Tomorrow we have Jeff Booth, best-selling author, talks a lot about this concept of technology deflation and how central banks try to offset that, and how he views that that's going to end. Really going to be a really interesting conversation. Really excited to have Jeff on. Listen, guys, you could have spent your last hour staring at any screen, any place in the world, but you chose to spend it with me in this allergy-filled.
Don't even start.
His wife brought a cat and dog home, so he's in a great mood. Well, thank you, everybody. We will see you tomorrow with Mr. Booth.